There is a single 3-digit number that decides whether you get the apartment, the car, the loan, and even the interest rate you pay for years. You did not choose this number. You cannot see exactly how it is built, and yet it quietly follows you everywhere. It is your credit score, and almost nobody actually sat you down to explain what really moves it, so let's fix that right now. By the end of this, you will know what genuinely raises your score, what is a total myth, and who is quietly making money off all of it. Let's start with how much this number actually controls. Most lenders in America lean on a score called FICO. That score runs on a scale from 300 at the bottom to 850 at the very top. Land in the higher bands and doors swing open. Land low and you pay more for the exact same loan everyone else gets. And we are not talking about pocket change. On a 30-year mortgage, a weak score can cost you tens of thousands in extra interest. So this number is not trivia. It literally sets the price of your financial life, which raises the real question. What actually moves it? Forget the rumors for a second. FICO is built from 5 clear ingredients, and they are not equal. The biggest piece by far is payment history. Simply put, do you pay your bills on time? That alone is about 35% of your score. One thing matters here more than anything. A single payment that slips 30 days late can drop your score hard and linger for years. So if you do only one thing, never miss a due date. Automate the minimum payment and you protect the single biggest factor. The second biggest factor is how much of your available credit you are actually using. They call it your utilization ratio. This one is roughly 30% of your score, and it is the factor most people accidentally sabotage. Here is the rule. If your card limit is $1,000, try to keep the balance you carry well under $300. Lower is even better. People with top scores often use under 10% of their limit at any given time. The third factor is the length of your credit history. The longer your accounts have been open, the more trust you have built. This is why closing your oldest credit card can actually hurt you. That old account is quietly doing you a favor. The last two factors are smaller. Your credit mix, the variety of loans you have, makes up around 10%. And new credit, how many fresh accounts and applications you have opened lately, makes up the final 10%. Notice what is missing from all 5. Your income, your savings, your job title, none of those are in your credit score at all. That surprises people. You can earn a fortune and still have a mediocre score because the score measures borrowing behavior, not wealth. So who is doing all this scoring? This is where the business model gets interesting. Meet the 3 credit bureaus. Equifax, Experian, and TransUnion. These companies quietly collect data on hundreds of millions of people. Every loan, card, and missed payment gets reported to them. They build a file on you, and you are not their paying customer. Here is the part that flips your whole understanding. You are not the customer. You are the product being sold. The bureaus sell your data and your score to lenders, landlords, insurers, and employers who want to judge you. And it is a massive business. Together, these bureaus and the scoring companies pull in billions in revenue every single year. FICO itself licenses the formula to lenders, and the bureaus sell access to the data that feeds it. Everyone gets paid. Then they turn around and sell your own score back to you, often through monthly monitoring subscriptions. Now, this system is not pure villainy. Before credit scores, lending was a mess of gut feelings, favoritism, and outright discrimination. A standardized score made lending faster and, in theory, more consistent. The same rules apply whether the lender likes your face or not. But a system built for the lender's benefit is full of myths that quietly cost regular people money. Let's bust the big ones. Myth 1. Checking your own score hurts it. False. Checking your own score is a soft pull and does nothing to it. Only a hard inquiry, when a lender checks to approve new credit, nudges it down slightly, and even that fades within months. Myth 2. You must carry a balance and pay interest to build credit. Completely false, and this one is expensive. You can pay your card in full every month, pay 0 interest, and still build excellent credit. The activity is what counts, not the debt. Myth 3. Closing a card you do not use helps. Usually it hurts, by shortening your history and shrinking your available credit. So who profits when these myths spread? Lenders profit when you carry needless interest. Subscriptions profit when you pay to watch your own number. A low score is not just your problem. It is someone else's revenue, because a lower score means a higher interest rate you pay them. Which is exactly why understanding the rules is power. So here is how you raise yours using the 5 factors you now know. 1. Pay every bill on time, automate it, and protect that 35%. This is the foundation everything else sits on. 2. Keep your utilization low. Pay balances down before the statement closes and aim well under 30%. 3. Keep your oldest accounts open, let your history age, and only apply for new credit when you genuinely need it. 4. Check your reports for free and dispute errors because mistakes are common and they are dragging real people's scores down. Do those 4 things patiently and the number climbs, not overnight, but steadily, and it moves to your side of the table. The score was never magic, and it was never about how good a person you are. It is a system, and now you can see how it works. That is exactly what we do here. We hand you the cheat sheet to the money machine. This is Brainonomics.